When the dominant form of investing simply becomes mindless contributions on a weekly basis or bi-weekly basis due to your paycheck into an index fund, it causes a predictable rise in valuations that unfortunately, I would argue many policymakers are interpreting as an all clear sign on the US economy. I think gold is overvalued at this point, although there are some caveats to that. I wouldn't be the least bit surprised to see the Trump administration engage in various forms of stimulus, for example, a tariff dividend check. The customer is always right. And the United States is the customer. And they have basically said, this is no longer acceptable to us. We are not going to shop at your store. We're going to actually tax the sale of goods that are occurring at your store uniquely.
Okay, ladies and gentlemen, so today we have Michael Green on our show, who is a portfolio manager and chief strategist at Simplify Asset Management. And today we will look at the US economy, we will talk about precious metals, commodities sector, advice for younger investors, and many other very interesting topics. So Michael, thank you so much for being here.
It's a pleasure. Thank you for having me.
Thank you so much, Michael. So very busy times in the economy with the precious metals and everything, but I'd like to start with the macro picture. So with everything that's going on, what is your assessment of what's happening with the US economy, and what would be some of the things that you are paying attention to right now?
I think the story in the US economy is unsurprisingly, I'm sure many other people have said this to you, is a bifurcated economy. It's an economy in which many people in the lower income or even middle income areas are genuinely struggling from both fear of job loss as well as significantly higher prices on everything from food to natural gas for heating homes, to higher home prices, taxes that have increased associated with those higher home prices, et cetera. This is creating a lot of stress in the bottom 80% of the US economy, while those at the upper income and those who are retired, particularly those who have retired with relatively significant assets, are kind of having the time of their life. They're enjoying relatively high interest rates. They have a society that has evolved largely to serve the needs of those at the upper end. And I think that this unfortunately explains much of the vitriol that you hear on both sides of the political spectrum and across generations, as those who have are doing very well and those who have not are really struggling.
Mm-hmm. And with the recent economic data, Mike, are we seeing clear signs of a slowdown?
Well, it depends on what you mean by recent economic data. As you know, we're in a shutdown with the US economy, and so much of the data that we usually rely on to provide us with information about the status of the US economy is delayed or potentially not going to become available. This is somewhat unprecedented in my career, and so many of us have been forced to turn to alternative forms of information. Private sector data coming from ADP suggests that the rate of hiring and job growth continues to slow markedly, having now turned negative. We do have secondary and private sector reports on inflation, which suggests that that has slowed, although in areas affected by the tariffs, which for many Americans would be things like Christmas toys, for example, are being inflated by the tariffs and the current trade war with China and to a certain extent the rest of the world. And so, we're relying on those data sets that are coming from the private sector. Those could include everything from surveys of loan officers to bank credit officers to reports coming from private companies, although we have to be somewhat skeptical in listening to quarterly calls from corporations. They obviously have an incentive to present data in the most favorable possible light that can actually extend to accounting treatment, right? If I roll over or extend credit terms because of financial distress, I don't necessarily have to report that as a delinquency or as a default in credit. In areas where they're not able to avoid that, we are seeing a rise in bankruptcies, corporate bankruptcies, personal bankruptcies, delinquencies, defaults, and in data sets that are available from areas that kind of are quasi-private, for example, FHA servicing, we're starting to see clear evidence of that slowdown.
Mm-hmm. And so, Michael, if we look at the CPI, so it's still above the Fed's target. And right now they're trying to lower the interest rate. So how are you viewing what's happening with that side right now?
Well, so I look at it in a slightly heterodox fashion, meaning I think of it somewhat differently than I think most people do. First of all, there's not a tremendous amount of evidence that interest rates within a meaningful range have a significant impact on inflation. So raising interest rates from 2% to 5% tends not to have a particularly important impact on inflation in and of itself. If we were to take interest rates to 20%, that would obviously cause a contraction in the economy that would manifest itself in falling prices in many areas. I apologize, there's an announcement going on. So when we when we think about inflation, the primary drivers of inflation are always going to be supply and demand. What we experienced in the United States and broadly around the world, regardless of interest rate policy, was a surge in inflation tied largely to a demand increase that was tied to the stimulus associated with the COVID era stimulus, as well as supply contraction that occurred because we shut the world down and then the frictions of reopening it restricted supply for a period of time. That peaked in June of 2022. Unfortunately, when Russia invaded Ukraine, we saw the impact of that in oil markets, in particular, energy markets around the world. Ukraine is obviously a large producer of grain. We saw momentary surges in areas like grain. That is continuing to ripple through, right? So inflation is not something that simply happens at one point in time. A really simple example of that is when grain prices, particularly soybean prices, rise, the cost of feeding cattle or feeding pigs rises significantly. That encourages farmers to slaughter cattle earlier than they might have earlier, which leads to a surplus, a temporary surplus of beef production or pork production. But that early slaughtering, particularly for long cycle commodities like beef, where it takes anywhere from 3 years to 7 years for cattle to mature into an actual animal that can be fully fattened and delivered for slaughter, those are now in relatively short supply. And so we're seeing those factors continue to ripple through. The other area in the United States that has been a persistent source of inflation has been the housing sector. Part of that is a real impact. The way that home prices have risen has influenced everything from the cost of insuring your home. So if your home is more valuable, it will cost you more to insure it. It has led to increases in property taxes, et cetera. Those flow through as higher costs of shelter, and those tend to persist for an extended period of time. There's also a mechanical component to that. The way we build our housing or our shelter indices in the United States relies effectively on a roughly 3-year moving average designed to smooth the series, reduce the impact of any one period. But that means that the official data is now lagging well behind the private sector data that we receive on shelter inflation, which has turned negative in most regions of the United States. And so, again, we're in a difficult situation where the data that we have is limited. The data that we have is in many ways improper for analyzing what's happening today. So, my general view is that inflation, although it has been increased by the tariffs, actually Alberto Cavallo, who's a fantastic professor, just released a white paper articulating that tariffs have increased CPI by about 0.7 percentage points, which is consistent with what my expectations were for the event. But unfortunately, that actually means that we're getting data that says that goods, which are largely those that are imported and traded with China and other regions of the world, are now showing positive inflation impulses, while many areas like services, which are provided by workers who are now worried about their jobs, is beginning to decrease quite rapidly in the United States, with about 75% of the US economy tied to services. That suggests to me that we're ultimately looking at a deflationary impulse across the broader economy consistent with that economic slowdown. That's what the Fed is trying to fight. So the Powell Fed, I think, lacking any clear theoretical grounding, has declared itself as data dependent. because the data is lagging, because the data is incomplete, and because in many ways it's improper for analyzing a rapidly changing environment, that means the Fed is perennially behind schedule in terms of hiking or lowering interest rates. They were too slow to hike in 2020 and 2021 and withdraw some of the stimulus that they provided, particularly to the housing market. The other area where, and now that we're seeing that slowdown, they also are very slow to respond. And as a result, I would suggest that for the broader economy, interest rates are way too high. We also have a problem, though, because the United States largely restructured after the global financial crisis. We moved away from short-term borrowing, which rapidly responds to interest rate increases or decreases, and shifted towards what's called term debt or longer duration interest rate exposures. That meant that the feed through to the economy of the interest rate hikes has been very slow to hit areas like homeowners, et cetera, where it has affected other countries more rapidly because of the predominance of adjustable rate mortgages. And it also means that many high income individuals who have significant cash assets or significant bond exposure are now actually beginning to see a dramatic increase in their incomes associated with those interest rate increases. That's helping to prop up that higher end of the economy. If the Fed cuts interest rates to help the portion of the economy like housing and automobiles that are struggling, we will ultimately see incomes fall as a result. And so the Fed has put itself into a very, difficult situation is the easiest way of framing it.
Thank you so much for that, Michael. And so many people who I interview, they do not really agree with the methodology that they use to measure inflation, the things that are included in the CPI. What are your thoughts on that? And do you agree with the methodology?
I think it's very important to distinguish what you're trying to do, right? So most people will see inflation primarily in goods that they purchase on a very frequent basis. Those sorts of fast moving components tend to be things like goods and services that you purchase at least on a daily, weekly, monthly basis. The gasoline prices that you pay at the pump, the food prices that you see in the grocery store, the cost of a haircut, et cetera. Those tend to move relatively rapidly and have been largely in deflation since about 2022. Those slower moving things like property taxes and insurance, health insurance, or even contracts that you enter into, like a renewing contract for a subscription, those tend to move relatively slowly. And so, the components of the economy that are continuing to experience inflation as a residual from that 2022 time period are falling but remain elevated. Those that are rapidly moving are being bumped up by things like tariffs. And so, I think a lot of people are very focused on their day-to-day expenditures, much less focused on the longer moving components. The methodology of the CPI is designed to represent the entirety of the purchasing basket. And there are many things that we purchase that we can't accurately describe. Really good example is the cost of my house, right? That doesn't actually, the price of my home doesn't meaningfully change my experienced inflation, except through very slow moving things like property taxes, insurance, et cetera. The BLS, who does the CPI calculations, really is genuinely trying quite hard to give an accurate representation of what inflation is. That means they have to capture things like improvement, right? You and I are having a conversation around the world on devices that wouldn't have existed 20 years ago, using technology that wouldn't have existed 20 years ago. Properly measuring that when you're thinking about the entirety of the economy is important, and it leads to things like hedonic adjustments or what's called imputed price estimates. That's where I think a lot of the complaints come from. And, those tend to actually be deflationary in nature. If you and I were trying to have this conversation in the year 2000, or even in, particularly in the year 1990, this call would have cost us somewhere in the neighborhood of $25,000 to $50,000. We pay nothing for it today, right? So those components have to be captured in the CPI. but they don't represent very well the day-to-day experience that people have, particularly because they aren't thinking about these types of costs. They never would have incurred, they simply would not have done an international video call for $25,000. And as a result, it wasn't part of their purchasing basket. A Zoom subscription is part of their purchasing basket.
That's a very, very good point, Mike. And so with potential slowdown in the economy and with the Fed trying to lower the interest rates, do you find the bond market attractive right now?
Well, what I'm always looking for is areas that are being neglected for a variety of reasons. And I think in part because of a narrative that has emerged that inflation is so high that the experience that people are having is one that they're broadly classifying as debasement. And that's being enhanced by the movement of traditional inflation metrics like gold or debasement indicators like gold. That's actually creating conditions under which people are, you know, very concerned about the fiscal status of the United States, et cetera, and convincing themselves that they should ignore the opportunities that exist in fixed income. It's also heavily influenced by the behavior of things like the stock market or Bitcoin or other areas that capture people's attention and provide them with a narrative that says, hey, you should be focusing on me, right? As a species, we are actually hardwired to look for movement, to look for things that happen in an aggressive fashion, both for defensive reasons, we want to watch for lions, and from a predator standpoint, we want to watch for things that are alive so we can kill them. Basic human trait. So, when you look at something like bonds, which are boring and slow and simply pay you a fixed rate of return with relatively modest movements in price, I think people tend to ignore those in this type of regime. But those are the type of investments that people really should be very thoughtful about, because we do have a somewhat unique opportunity to lock in what I think are too high interest rates relative to the level of inflation and economic activity. My expectation is that the Fed will continue to cut interest rates, which means people are unlikely to have the opportunity to earn the yields that they currently have, and even more accurately, the yields that existed just 6 months ago in things like 30-year bonds and Treasury inflation protected securities, which offered extraordinary high real yields relative to their history.
Mm-hmm. And if we could talk a little bit about stock market valuations right now. So if you look at all the historical measures, they look quite richly valued. So how are you viewing, let's say, S&P 500 and some of the, let's say, Max 7 valuations at the current level?
Well, I think they're extraordinarily high, and I think they're undeservedly high. But I would guess that you're aware of the research that I've led and pushed on the impact of passive or index investing on stock markets. They have an inflationary component to them, meaning they drive prices and valuations and importantly concentration higher. The advance in the S&P that you're seeing with it at all-time highs is largely driven by a few very large stocks. All stocks are inflated by this impact, but it's particularly concentrated in those with large weights in the indices. And that, more than anything else, is, I think, leading to a sense of confusion. People are seeing prices move significantly higher. They presume that there's information content in the stock market. But when the dominant form of investing simply becomes mindless contributions on a weekly basis or bi-weekly basis due to your paycheck into an index fund, it causes a predictable rise in valuations that, unfortunately, I would argue many policymakers are interpreting as an all clear sign on the US economy, even as we're seeing that deterioration occur underneath.
Yes, and but that can't last forever though, right, Michael?
Um, Unfortunately, as long as the dominant form of investing is people contributing from their paychecks and contributing from their paychecks into a stock market index, that can continue. And, I was on record 5 years ago saying it's going to get crazier. 2 years ago, it's going to get crazier. And I'm here to say, like, as long as that system persists, it can get crazier and crazier and crazier. So, I think unfortunately it can persist, in the words of John Maynard Keynes, far longer than most of us can remain solvent if you want to try to fight against it.
Hmm. Uh, so talking about crazy, Mike, gold has performed really well recently. It had a huge move now. It's having a lot of volatility. If we could talk about some of the drivers that you believe got gold to these levels, and how are you viewing this asset at the current price as well?
Well, I think gold is overvalued at this point, although there are some caveats to that. I would suggest that distraction from gold in the form of Bitcoin has contributed to gold being relatively disregarded by the US investor public for an extended period of time. The real move in gold began when the US imposed sanctions on Russia, um, confiscated effectively their treasuries, handing them over and the proceeds from those to the Ukraine for use in fighting against Russia. That was a very clear signal sent to countries that in some ways oppose the United States, like China, that US treasuries were no longer a safe asset on an international central bank basis. And it forced them to begin to diversify the excess, the surplus that they've been generating from their unprecedented trade surpluses with the United States into gold instead of US treasuries. I think this has contributed to the neglect that I was highlighting before about treasuries. I think it also drove an increase in prices in gold. And then, as I articulated, as a human species, we're wired to look for that movement. We're wired to look for shiny things that are moving fast. And gold is about the clearest form of that. In the last 12 months or so, the US retail investment public has moved very aggressively into gold through things like the gold ETFs, to a lesser extent into things like gold miners. And that has contributed to the further increase in price. So you now have effectively two engines adding fuel to gold: the diversification of resources from China, as well as the US investment public now chasing the asset to, what I would argue are historically extraordinarily high prices, certainly relative to other metals and other forms of commodities like oil, even copper, et cetera, look extraordinarily cheap relative to gold. That has historically signaled quote unquote bubble like characteristics in gold. I wrote about this a couple of weeks ago, basically saying, look, we've gotten to an extreme valuation in gold. My expectation is people will begin to diversify away from gold into other commodities like oil or like copper. And we're starting to see some indications of that. Whether that can be maintained or not is ultimately going to be heavily influenced by the economy. Inventories of most materials and metals are actually at very high levels. Inventories of oil are at high levels relative to economic output. There's not a particularly supportive environment for commodities unless you believe that the geopolitical sphere moves fairly rapidly into outright physical conflict, which certainly, as someone from Ukraine, you're aware has been ongoing in quote unquote small scale form for an extended period of time. But it really has not provided any meaningful disruption to commodity supply around the world yet, right? That yet is really key. If we start seeing things like blockades of Taiwan, or we began to see things like blockades of the Panama Canal, the Suez Canal, et cetera, those would begin to change the picture quite rapidly.
Mhm. And if you look at commodities like copper, Mike, sector has been underinvested for a very long time, and it takes so long for the new mines to get permits and everything. Would you see a problem there for the future supply?
On a relatively short-term basis, I think the answer is yes, right? Very similar to the description I've provided about cattle or pork, right? It takes about 18 months for a pig to mature to the age of slaughter. It takes about 6 years for cattle to get to that point. Cocoa, which was a commodity that exploded in price over the past couple of years and is now retreating rapidly, that's a tree that requires a minimum of 3 years. Things like wheat and soybeans, et cetera, those are semi-annual crops that are produced on a continuous basis. Many of the shortages have already been addressed in those areas. We've seen surges of production. And because the global population is really not growing very fast, particularly in the developed world, there's not actually a lot of pressure on the demand side once you recover from something like COVID. We need to see significantly further disruption. You highlight copper. Copper, I would note, has a very, very long lead time. It tends to be about 10 to 15 years from the point of discovery to the point of production. You have to go through extensive permitting, again, particularly if you're doing it within the developed world. Um, that means you can enter into relatively long cycles, but copper itself is a easily substitutable metal in many situations, and technology is always working to resolve those shortages. So I just unfortunately refuse to engage as a Malthusian shortage, believer that we're going to run out of copper or that we're going to have persistent shortages of copper. I think ultimately human ingenuity trumps any sort of physical shortage as long as you have market economies that are capable of responding to the price signals of higher prices by either substituting less copper, which we've seen significant amounts of, or by introducing alternatives to copper, things like high technology, high temperature superconducting wires, or replacements for copper in various uses. Those tend to trump the shortages far earlier than the supply component begins to really manifest itself. And that really is unfortunately what we saw in the cycle following the global financial crisis. Many people highlighted the underinvestment that has occurred there. That is measured against a world that we look at largely through the lens of the 20th century, in which global population exploded and the uses of copper exploded in terms of the different types of demand. There's less evidence that that's really happening today. And so, I understand the demand that's coming through areas like data centers. I understand the potential demand that would come through electric vehicles, the EV markets. But ultimately, again, I think we're going to see technology and human ingenuity lead to substitution and replacement probably long before the quote unquote shortages are discovered.
That's very, very, very interesting, Mike. So a lot of people who I interviewed, they would look at the commodity sector and then they will also look at the ratio charts. And if you compare that whole sector almost to anything else, it looks extremely undervalued, right?
Well, it looks extremely low in terms of price, but that's a persistent feature. So occasionally I share charts of gold or oil copper or gold or nickel or wheat in gold terms, which is actually a very valid way of thinking about it. You're comparing one commodity to another, as you said, a ratio chart. I agree that gold is exceptionally richly valued versus almost all other commodities. But because I'm aware of the sources of demand, the introduction of Chinese demand away from US treasuries, the chasing of momentum by the US retail investor, and the increasing excitement, which is a terrible word to use for it, but for the debasement trade, I would argue that the demand side for gold is being artificially inflated, driving that price very high relative to other prices of commodities, which are much more subject to actual industrial production and demand, excuse me, and broader consumption demand that really doesn't affect gold in the same way.
Mm. And so, Michael, so we talked about some of the big geopolitical reasons that are pushed gold to these levels. But if you look for the next few years, it doesn't look like the situation will change, right? So I suppose that potential demand from the central banks should continue and should put a certain floor on gold price.
There is certainly an argument that can be made for that. At the same time, I would highlight that the primary source of that demand impulse has been the conflict between the United States and China's extraordinary trade surpluses with the United States and the rest of the world. As the rest of the world begins to push back fairly aggressively against China for exporting their surplus production and challenging job creation in regions all over the world, not just the United States now. One of the biggest impacts of the US tariff has been to redirect growing Chinese surpluses into regions like Europe, South America, Africa, et cetera, that are beginning to push back very aggressively against China. That suggests that China is ultimately going to be the loser in this battle, that they will be forced to either consume more internally, which they've just announced following their recent plenum, or they're going to be forced to address a significant slowdown in their economy that would result in less demand for gold because they'd be running lower surpluses. So I think it can work in both directions. I actually would somewhat push back and say, for all the concerns I have about how the Trump administration in the United States has handled itself on the global stage, the reality is that the United States has been the consumer to the world. It's less common in Europe, but certainly in the United States, there's the expression, the customer is always right. And the United States is the customer. And they have basically said, this is no longer acceptable to us. We are not going to shop at your store. We're going to actually tax the sale of goods that are occurring at your store uniquely. There's not much the rest of the world can really do about that.
And so, Mike, would we be able to talk about maybe a certain sector that you do find attractive right now?
Well, as I indicated, I think ultimately that I may have to plug in my computer here for 1 second. Okay. I mean, I do ultimately think that bonds are relatively attractive, although on a short-term trading basis, much of that has already been built in the products that I manage. I've reduced some of my duration exposure as more and more people get very excited about the idea that, oh, the 10-year is rallying or the 30-year is rallying. Everything has been fixed in the bond market. Positioning remains low in those areas, and there is the potential for continued improvement, as well as what I refer to as the endogenous returns, simply the interest payments associated with those, make them relatively attractive versus other types of assets. On the flip side of that equation, sentiment is already extraordinarily depressed within the United States. Many of the actions of the Trump administration so far have proven to be contractionary, things like introducing tariffs. As we look into next year and the potential for the midterm elections, I wouldn't be the least bit surprised to see the Trump administration engage in various forms of stimulus, for example, a tariff dividend check that ultimately ends up inflating incomes at the lower end, driving another surge of demand, improving sentiment, and creating a temporary sugar high in the US economy that would ultimately prove somewhat negative for bonds. There's also the persistent problem of rising oligopoly or monopolization within the United States tied to concentration of the corporate sector, the process of M&A and private equity accumulating and building horizontal acquisitions, which would historically have been barred by the Federal Trade Commission in terms of antitrust activity, was neglected for a period of about 30 years. That's given many of these companies pricing power in which they are now able to, in a period of what's called pricing uncertainty, right? We just don't really know what prices should be after the high volatility that we've experienced. That creates the potential for those corporate entities to take advantage of that and try to push through price increases. If that begins to flow through in the limited data sets that we have, that will likely lead to the Fed becoming concerned about cutting interest rates further and could actually create a temporary sell-off in the bond market. I'm concerned about that at this point. We're approaching that end of year period. I've gotten the annual notice from Microsoft that the cost of my 30-year-old Office software is inexplicably gone up by 30%. Fortunately, that doesn't affect me dramatically, but for many people, particularly students and others, that could actually be kind of the straw that breaks the camel's back, where they just don't have the money to pay that. So we'll see. This is a battle between corporations that want to raise prices and individuals who are struggling to meet their bills.
Definitely. And so, Mike, I like to ask this question for the younger audience. So if we have an individual who's still at the beginning of his or her wealth-building path, with so many options now, so many different sectors, what advice would you have for them when they're still, they want to get started, they want to get involved, they want to invest, but, what advice would you have for them so that they don't get burned too much and don't get too many mistakes?
Yeah, I think unfortunately the younger generation has been deeply disadvantaged by the experience that they've seen for the past several years. As I articulated, I think the rise in valuations of the stock market and to a lesser extent the rise in valuations of home prices um, has created conditions under which they think that the world is effectively running away from them very quickly, right? They feel incapable of effectively getting themselves on that ladder. I don't actually think that's true. I just want to emphasize this. And so there's an element of hope associated with it that simply says, as long as you as an individual remain productive and innovative in the approaches and solutions that you bring to problems, the world will be the path to your door for a better mousetrap. Um, what I strongly encourage young people to remember is that there is actually a path. Their parents followed it. My children have been directed to follow it. And as a result, they're trying to build wealth and value slowly. The most important part of that is building their human capital, gaining experience in relevant jobs, gaining experience in relevant education. I am a very strong critic of the US educational system and a little bit less so of Europe, although I think in both regions we have focused education on more of a holistic life experience as compared to actually obtaining usable skills. My children largely pursued vocational educations. While that doesn't sound, they won't sound vocational. My children went to business school and studied finance, or my youngest son is going into the US military as a naval officer. Those are areas in which you build human capital as compared to necessarily gaining perspective on whether or not underwater basket weaving should be best done with, actual wicker or whether you should use a petroleum-based substitute, right? Learning how to weave baskets underwater is not a useful skill, nor is particularly studying the history of a particular race or culture or learning about art history or music history. Those are not particularly saleable skills. And as a result, if you pursue those, you should expect to have a deteriorated expectation for your life ahead. We've robbed young people of many of the signals of that. And as a result, they tend to underinvest in the human capital while simultaneously looking with despair at the material goods that they want to acquire and saying, there's no way for me to get this other than the big scoring gambling. And gambling in its explicit form, whether that's gambling on cricket matches or football in the European sense or football in the American sense, is not a path to wealth. It's a path to ruin, path to dependence, it's a path to loss. And yes, there will be individuals who do extraordinarily well, and the vast majority of people are going to lose. The lottery has a similar characteristic, as do meme stocks and crypto tokens, et cetera. These are all things that have been sold to people as well. It's a low probability that you'll get rich, but it doesn't require that much for you to get a spot in the game. You're basically throwing your money away on those, and the cumulative result is likely to end up with people being far worse off. As much as I'm a critic of investing in the stock market, as much as I'm a critic of investing in startup businesses, et cetera, I really strongly encourage people to put themselves on a path to saving and building wealth slowly and focusing on that human capital side in your 20s that positions you to harvest that crop in your 30s, 40s, and 50s.
Great advice, Mike. Thank you so much for that. So these are all the questions I had. Is there anything else that you would like to mention that maybe we haven't covered?
Well, I just think that, the most important point is what I just shared, which is ultimately that life is a journey. You're going to go through it one way or another. When you think about a journey, one of the worst things you can do is get yourself off onto a detour at the very start, right? It throws the rest of the schedule into chaos. Some of those detours are by choice, right? Instead of focusing on saving and building human capital, you decide that you're going to lock in and learn how to speculate in, perpetual futures on crypto. Um, it's just not a particularly useful and marketable skill, right? And it's likely to result in capital degradation rather than wealth creation. Um, at the same time, one of the things I think distinguishes me from many other people I hear commentating is that I genuinely love human beings. I have so much respect for the human race and our capability to change the world. That's what we have done through technology. It's what we've done through human capital enhancement. And ultimately, things like AI and other components are tools that can be used by humanity to make the world a much better place. So I actually, while I'm concerned locally and very concerned about the economic conditions that most Americans, and candidly, it's even worse for much of the rest of the world, are experiencing, the simple reality is that the long term is always so bright that you might as well put on shades right now.
So, Mike, I really enjoyed this conversation. Thank you so much for your time, and I'd love to have you back on the show.
I appreciate it, Vlad. I look forward to doing it again.